Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Now, my two regular co-hosts, Mark Hanf and Nam Phan, are off today. We will have a special guest in just a minute here, but our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. Our special guest today, who is on with us right now, is reverse mortgage specialist Mary Jo LaFaye. Mary Jo, welcome back to The Best of Investing, as you've been our guest a couple of times. How are you?
I'm doing good. Thank you.
Good. Now, have there been a lot of changes in the reverse mortgage business the last few years?
Well, Edward, there are always a lot of changes in the reverse mortgage business.
Okay, good.
It's an ever-changing space, and luckily most of the changes we're getting are improvements. Our most recent change is our jumbo reverse mortgage, which is one of the most popular loans in California because it will loan up to $4 million.
Oh, wow.
Raised the loan to value ratio on those loans just recently, a few weeks ago. So the interest rates are holding steady. They're about 40–60% less than they were 4 years ago when they brought the jumbo reverse mortgage back on the market after the 2008 crisis.
Okay.
They were gone for about 10 years and they brought them back. They were a high interest rate and they've slowly whittled away and they've gotten lower and lower. So now we have a fixed rate at 4.9. That's not the APR, so we have to quote APR, which I can't do unless I have more information from a borrower, but just to let you know, a starting point. And then we also have it available as a credit line. So those are popular. People can get $4 million to pay for care and so forth without having to qualify for that large loan, since it is a repayment deferred loan.
And what's the highest loan to value?
Highest loan to value is around 70%. I actually have a gentleman right now in Mill Valley who just turned 100, and we're refinancing his reverse for the second time to give him more money and potentially at a lower rate than he currently has. So this will be his third reverse mortgage lifetime. Yeah, pretty amazing.
And I guess in his case, the reason is the interest rates went down. And if his property's gone up in value, then he qualify for more.
So his age has gone up, his property value has gone up, the loan to value ratio has gone up, and the interest rate has gone down. So he has a lot of reasons to, to endeavor into this. And he's so funny. He's really a bright guy at 100. He hasn't lost any of his cognitive abilities at all. He says, Mary Jo, I'm just planning for a 4-year timeline. And so most of us have to plan for a 30-year retirement. At age 100, he feels like planning for 4 years is sufficient.
Wow. And I guess one of the neat things about the high loan to value is, since you never have to make a mortgage payment, you can't get foreclosed out of your house.
Right. As long as you pay your property tax, homeowners insurance, homeowners association dues if you have an HOA. And then, of course, you're responsible for maintenance and utilities, just like if you had no mortgage at all. So you have all the same responsibilities as if you had zero mortgage, if your house was just free and clear. But you get to, access, 40 to 70% of your equity. Since the proceeds are defined as loan proceeds, the IRS says that loan proceeds are non-taxable. So a lot of people, this will help pull them back down to just living on their retired minimum draw, their required minimum draw for their retirement, and they don't have to take more than that. They can take the rest on a tax-free basis from their home equity.
And there's a special situation, if I remember correctly, if somebody does not have enough income, the reverse mortgage company will effectively impound for insurance and taxes for a certain period of time, right?
Right. So qualifying for these loans is fairly easy because you just have to show that you have enough ongoing income to pay your property taxes and homeowners insurance. HOA dues and maintenance and utilities. And maintenance and utilities is calculated at 15 cents a square foot. So that doesn't typically add up to much. And then after paying those things, you have to have about $500 per person left over for basic living expenses. So most people qualify based on their Social Security. And we can also use the loan proceeds. So if they do a really low Social Security, but they have a lot of loan proceeds available, then we can use those as a drawdown basis to qualify them. The reserve accounts come into play when a borrower has been deficient or late on paying their property taxes and homeowners insurance. HUD requires that we have to prove to HUD for them to insure the loan and for us to be able to fund the loan that the borrower has a very, very low chance of defaulting. And of course, they default by not paying their property taxes and homeowners insurance. So if they have a history of not paying them, then we would need to take some of their loan proceeds and set those aside into like a reserve fund to pay them, pay their property tax and homeowners insurance for the borrower for their life expectancy. And for a lot of people, they'll choose to do that even if they're not required to, just so that annual or semi-annual responsibility of remembering to pay them is now on the lender. And so as maybe their memory starts to get a little less dependable, or if they want to travel a lot and don't want to have to worry about that, then they'll just let the lenders do that set aside. So that's optional if you're not required to have it, but if because of a history of late payments, if you're required to have it, then it would be set up for your life expectancy.
Okay. Tell you what, we're going to cut to a first commercial break. When we come back, I want to ask you a question about if somebody lives such a long time that the loan grows too large. Okay.
Great.
All right. First of all, I want to make a quick mention here for Live Life at the Mount View Hotel in Calistoga. Every afternoon, enjoy vino and vinyl wine tasting, and on Friday, Saturday, Sunday, join them for dinner and a movie on site as they've remodeled the location to accommodate the outdoor movie theater. And when you're ready for a change of scenery, make yourself at home at the Mount View Hotel in Calistoga, making memories for 100 years. That's themountvviewhotel.com. All right, our first trivia question. And again, remember, Mary Jo, if you know the answer, don't say anything until we get back. All right, what were most pennies made out of in 1943? All right, that's our first trivia question. Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We'll be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with my special guest, Mary Jo LaFaye, who is a reverse mortgage specialist. Both Mark Hoff and Nam Phan are off today. Let's first go to our first trivia question. What were most pennies made out of in 1943? Do you know the answer to that, Mary Jo?
Silver? I don't know.
No, steel.
Oh, really?
It's I think it was the only year that they made steel pennies because they needed the other for the war. They needed other metal for that. It's kind of a different kind of question.
It's impressive that they were making them at all, really.
Yeah, I know. Of course, now they wouldn't necessarily need pennies because of inflation, the nickels and dimes. Okay, quick question for you on the reverse mortgages. So what happens if you have, like when let's say that your client who turned 100, let's say he was 70 and he had first taken out a reverse mortgage. I'm not sure what the life expectancy is for a 70-year-old for reverse mortgages. Do you know what that is?
I think it's around 86 or 88.
Okay.
Yeah.
So then let's say he hadn't refinanced.
Right.
And he lived past 88.
Right.
At what point, if he just kept taking money, would he have exceeded? Now, we don't know if the house would have gone up in value.
Right. Yeah, that's the thing. In California, it's pretty hard for interest to accrue and surpass your appreciation because the interest is accruing on a debt that's much smaller than your home value is. So if your home value is $1 million and you qualify for a loan of 500, and most people don't take it all at once, although you can. But let's say you're taking, 50,000 or 100,000 a year. Even if that is accruing at 4 or 5% and your home value The average appreciation in Marin County for the last 60 years has been about 8%. So if you've got 8% accruing on $1 million and 4% accruing on 500,000, it's never going to catch up. You're actually increasing your equity each year.
And the interest is not compounded, right? It's simple interest.
No, it is compounded.
It is compounded.
Yeah. So the interest on your loan is compounding, and the appreciation on your house is compounding.
True.
The growth on your investments is compounding. So we kind of live in a compound world, unless you have like a loan from the county or something, or I think student debt might be simple interest.
Gotcha. I guess you always have the choice of paying the interest.
You can make a payment of any amount at any time.
Okay. So if you do that, then it wouldn't compound, because you could theoretically just keep it the same.
Yeah, and some people will do that. They'll get these loans not because they don't want to make a payment anymore, but because they don't qualify for a conventional loan. And so as long as they're working, let's say they're 62, they get the reverse mortgage and they wipe out their conventional loan, so they're no longer required to make a payment, but they're planning to work till they're 70. So they keep making a payment, but then let's say they get laid off at 67 unexpectedly because of a financial crisis or a health crisis.
Yeah.
The next month they don't have to make their payment, and they never have to make it again. So they're kind of in a really flexible position that way. Yeah. But the loans are non-recourse. So even if somebody does end up owing more than their house is worth, which probably is more likely to occur in areas with very low appreciation, like maybe the southern United States or areas that just don't have a lot of growth, then they're not liable for the debt, and nor is their estate. None of their other assets are ever liable for the debt. If they're HUD insured loans, HUD will be liable for any deficiency at the end of the loan. If they're proprietary reverse mortgages, then the lender will take the hit.
Okay, so the worst that could happen is if somebody's house is worth $500,000 and their loan grows beyond that, all that would happen is the lender would own the house, basically.
Right. Yeah. The house would be sold, and then whatever they get for the house would go to pay off the debt. If there's additional money owed, the lender just writes that off on their losses, and then they actually have to leave 5% for sale fees too, so the family can get stuck with that.
Exactly. No, I got to think that, especially maybe during COVID, you were probably very busy, I would think.
Very busy, yeah. And a lot of my clients right now are actually refinancing reverse mortgages or conventional loans. And so that's
primarily just because the interest rates have dropped?
Yep, interest rates have dropped and their home values have gone up. So I have clients that their home value has gone up $500,000 in the last 2 years.
Really what's kind of neat for you is it's not necessarily a one-off type deal.
Right. Yeah.
You probably get a lot of repeat clients.
I thought when I started this 18 years ago, I thought it would be, because I was in California at the time, so I didn't understand California home appreciation. And of course, 18 years ago, 10 years ago, and today people still say the same thing. Well, my house can't possibly appreciate anymore.
Yeah. Well, it's interesting too, because we're not in a credit bubble. Which is good. So it's going to be typical supply and demand type of situation.
And, I learned something recently that the millennials are actually the largest group of people ever. They're larger than the baby boomers.
Who are buying
homes.
Yeah.
And then you've got, I think, about 20% of the homes being purchased today are being purchased by large investment funds. So that's
interesting.
That's adding a lot to the frenzy.
Well, I think it took a while for the millennials, because their parents experienced the Great Recession.
Right.
And so probably while they were going through that as youngsters, they said, well, wait a minute, I don't know about it as owning a home type situation. Mm-hmm. But then suddenly all these houses are going up in value, and they said they don't want to miss the gravy train. And
the rates, they know they're never going to get a rate like this. So it makes it really a lot more feasible to enter the market when you're paying 2.5% interest.
And so I'm trying to think of what are the downsides for having a reverse mortgage?
People ask me that. That's one of the most common things I get when I do my educational luncheons. It's too good to be true. Yeah. And had a financial advisor attend one time, and he said, no, it's not too good to be true. It's too good to be free. And it's not free. It's a loan. And there's interest.
That's actually that's very good.
Yeah. And I thought that kind of highlights the reality of it, that it's just a loan and it's designed specifically to help older Americans be able to capitalize on all the appreciation they've accessed and worked so hard for, without having to sell their home if they're not ready. And a lot of people will take out a reverse mortgage while they're both around, and then when one person passes away, if they own it community property, oftentimes they're able to get that stepped up basis and sell and save the capital gain taxes. And I'm not a tax advisor, so I can't give you tax law, but that's something to check out. You know, a lot of people don't realize that when one spouse passes, they may be eligible to sell their $4 million house and not have to pay $1 million in capital gain taxes, be able to keep all that money. So that makes that reverse mortgage interest seem really like a bargain.
Exactly. Yeah, it's very similar to Pacific Pipe money, where people say, gosh, this is such a great deal. You know, you get to borrow money quickly to buy your house. And what's the downside? Well, downside is it's a little bit more expensive for the money, but when you can make an aggressive offer and not have to move twice, there's a lot of benefits to it that actually might save you money. Tell you what, we're going to cut to our second commercial break here. It goes fast. All right. How many zeros are there in a trillion? That's our trivia question. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate, which is, by the way, worth over $100. How many zeros are there in a trillion? All right, stay with us. You're listening to Edward Brown and Mary Jo LaFaye on The Best of Investing. We're going to finish up with Mary Jo and then come back and talk a little bit about other financing options. Well, welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mary Jo LaFaye, our special guest. Mary Jo, how many zeros are there in a trillion?
A lot.
A lot. There you go. That's the answer. No, somewhere between 0 and a lot. What number is there?
Exactly. Somewhere between 0 and infinity.
Yeah, that's right. You want to give an answer to that?
How many zeros in a trillion? Let's say 9.
12.
12. Okay.
So a billion would have 9.
Right.
Close enough. All right. So Mary Jo, when just before we came back, you were starting to talk about a certain tax strategy that I think would be very valuable for people to know.
Yeah, so there are actually a lot of ways. And again, I'm not a tax advisor or a financial advisor by any means. So don't take any of this as tax advice, but it is something that you can check out on your own or talk to your CPA about. That I've been actually working with quite a few clients that are in a position where they want to sell a highly appreciated primary residence. Okay. And there are multiple ways that you can structure the sale of a highly appreciated primary residence and combine what they call the 121, which is the ability for a homeowner to get between $250,000 to $500,000 free gain when they sell a house. Okay. And that's the IRS regulation 121. And then there's the 1031, which allows a property owner of an investment property to defer the capital gain tax by reinvesting the money from the sale of an investment property. And so I recently helped a client who had lived in their home for 40 years and they had rented it out for 2 years. And because they did that, and there are lots of ways to do it. You don't have to rent out the whole house. You could have a home office. There are a lot of different avenues to be able to combine the 121 with the 1031. And so they were able to exit a $2.3 million house. They would have owed between $450,000 to $500,000 in capital gain taxes. Yeah. And instead they were able to take that money and defer it defer the capital gain tax by investing it into a Delaware statutory trust, which is now paying them $24,000 a year. And then they took the $500,000 free gain and used it as down payment money on a new house. And then I funded the rest of the purchase with a reverse for purchase loan. They call it a HECM for purchase. So now they're in a new home with no mortgage payment, and they were able to invest almost $500,000 for future income and avoided about $500,000 in tax. So a lot of ways.
That is very strategic.
Yeah, it really was. It took a lot of people. So I brought in the realtor. We told him what we were doing, and then the new realtor that helped them find the property. We brought in a CPA to vet it and make sure that all the I's were dotted and the T's were crossed, and then the DST specialist who had actually done it before.
Yeah.
And together as a team, it worked beautifully. The client is so happy, and they got out of an expensive property where they owed $1.05 million, and that was not going to work for their retirement plan. So
was there, except for maybe the cost of hiring the accountant and all that, was there any downside? I'm trying to think of what.
They are thrilled. They're in a newer one-level home with a pool and a hot tub on a cul-de-sac. They're very happy. And again, because that was almost a year ago that we did that, last October, by the time the 1 year comes around, their home will have probably appreciated a few $100,000, and we may be able to refi and pull more money out for their retirement.
Wow. So. And I guess, and I'm trying to, I'd have to work out the numbers, but maybe the only downside, which really isn't a big downside, is that their basis in their new house is not that huge. But who cares? I mean, if they're not planning on selling it, then...
Well, no, their basis in their new house is their purchase price, because that wasn't part of the 1031. The 1031 money went into the Delaware statutory.
Oh, gotcha. Yeah, that's correct. Yes, that's right. Okay.
And then what I was told, and again, I can't verify this because I'm not a tax advisor, but I was told that if their kids inherit that DST, that Delaware statutory trust, the new basis on that will be the value that it's at when they inherit it.
Okay, the step-up basis on that. Interesting. And so we won't go into too much of DSTs right here because we're not specialists in
No, definitely not.
But basically, it's just, if I understand it, instead of there being a 1031 exchange into one specific property, it's spread out almost like a mutual fund.
Exactly. Because the problem is, in order to do it into another property, they would have had to replace the debt. And they didn't qualify for a new loan of $1.05 million, nor did they want to be in a position of having that liability. So the DST allows them to do it. The DST already has the debt, and they can just assign them whatever portion of the debt they need on a non-recourse basis.
Oh, now that's pretty cool. Yeah. I got to say, that's pretty cool. And again,
I've been wanting to do that since I heard about it 15 years ago, and I finally found
How long have DSTs been around that long?
No, but somebody told me that Allstate used to have a real estate-based annuity that you could do it into, and I don't know if that exists. I don't know how long DSTs have been around. Actually.
Yeah, I think less than 5 years. But again, we're not experts in that area, and we always suggest you talk to your tax attorney and DST specialist on that. All right. Well, Mary Jo, we got a couple more minutes before we have to cut to our next break. Anything else you want to share with us about that? Well, first of all, give out your information, because you're a wealth of information when it comes to reverse mortgage.
Yeah, I've been in this field for 18 years, and I've really built my business by offering myself as a team member to solve retirement income problems. And whether it includes a reverse mortgage or not, I have kind of, gained a lot of knowledge by working with all these different professionals, and I'm happy to, brainstorm with people and offer any information I have and connect them. I have a lot of great resources. So a lot of times I'll just connect people with the right person and kind of, give them an idea of what questions to ask and what specialists they should be talking to. And then just send them on their way. And I always tell people, I'm here as your resource. Yeah. Whether it's, means you're going to do a reverse mortgage or not. I'm a compulsive problem solver. So always happy to find a solution, help people find a solution that really works for them.
And give out your information one more time, and then we'll cut to our next break.
So I work for Mutual of Omaha Reverse Mortgage in San Rafael. I'm down on 4th Street. My phone number is 415-259-4979. And you can always just go to my website, which is maryjolafay.com. That's Mary Jo, and there's no E on the end of Joe if it's a female. And last name LaFaye, L-A-F as in Frank, A-Y-E.com.
Very good. Thank you. All right. Here's our third trivia question. What nickname was given to Mafia boss Charlie Luciano? Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Stay with us. The Best of Investing will be right back. Well, welcome back to the Best of Investing. Edward Brown here, along with Mary Jo LaFaye. Third trivia question. What nickname was given to Mafia boss Charlie Luciano?
Oh, gee. Charlie Horse.
No, Lucky Luciano.
Ah.
You ever heard Lucky Luciano?
No, but did he die, or was he lucky and he escaped?
Actually, he was deported. He's one of the few guys who was deported before he had a chance to get. Well, he actually got caught and got deported. He was one of the earlier mafia bosses. But anyway, okay. So let's see here. Moving on. Well, I was going to give a deal of the week here for Pacific Private Money. As most people know, Pacific Private Money provides short-term loans to people who want to buy real estate. Usually the banks can't work fast enough, or people want to make an aggressive offer and need a bridge loan. So people check out pacificprivatemoney.com. And here's a loan where there was a lady who was an older lady, and she owned her property free and clear. She wanted to downsize, so she wants to sell her property, hasn't sold it yet. And she actually got a first mortgage of a HELOC on her primary residence, but it wasn't enough. So, and it turns out she actually has money in a brokerage account, but she doesn't want to touch that. Mm-hmm. So we're going to be lending her $500,000 on a property that's worth about $1.5 million. And, it's going to be a little bit more expensive than getting a regular loan, but it's going to solve the speed, getting it quickly. And also because her income is not high enough, she wouldn't qualify for a loan with a bank for this new house, especially since she's getting the HELOC on the old house. So all these, a lot of people are in this kind of an interesting situation where, one would look and say, well, of course this person is a safe bet. Right. And so from Pacific Private Money standpoint, they're making a $500,000 loan on a property worth $1.5 million. Probably, and the lady's got enough money to pay cash for the property, but she just doesn't want to touch her savings. Maybe she's earning enough on her investments and her stocks, bonds, whatever she's got. So, on the one side, we have this person who wants to borrow money, and from the investor standpoint, because there are people out there who say, gosh, that sounds like I'd love to invest in a loan like that. So that's part of a portfolio that Pacific Private Money funds. And it acts very similar to a mutual fund. It's not exactly a mutual fund, but it acts similar to it. And people can invest in the fund. And right now, the main fund, which is about $63 million, is paying a minimum preferred return of 7%. And there's no fee to get in. There's no fee to get out. There is a 12-month hold. Minimum investment's $50,000. So far, no losses. So they've done a very, very good job. And anytime anybody's needed to get their money out, they just need to give them 30 days notice after the 1-year period. And there's been no problem going ahead and cashing people out. Mm-hmm. The interesting question that comes up for people, which is a legitimate one, is, well, what if there are too many people who want to get out at the same time? Mm-hmm. And there's not enough money in the bank account, and there's not enough loans that are paying off quickly, because again, most people will borrow money and then they will either refinance with a conventional lender or they'll sell another property to pay it off. So the money is constantly flowing into the fund and out of the fund. And the interesting thing is that Pacific Private Money's fund that's got $63 million, it's spread out amongst, I think, probably close to 70 loans. They have the ability to sell loans and sell them actually at a profit. So if they need to liquidate, they could always sell, like this loan, for example. They could sell this loan to an individual investor, get cash, and then cash out people who want to get out. So even though it technically is not liquid from the standpoint of, calling up a stockbroker and getting it liquid, there's so many, it's not as illiquid as the old days. Right. There's so much money out there that is looking for loans like this. In fact, they have another fund called the Freedom Fund that is paying a straight 6% interest, but it's got a $250,000 minimum, and there's no hold on that one. And the reason is because they're able to package loans and sell them to Wall Street. and they do that on a rotation of anywhere from 2 to 3 weeks. So it's like a conveyor belt. Money goes out, money comes back in, money goes back out again. And the contracts they have with Wall Street are, I think, 18 months to 2 years long.
Oh, wow.
Yeah, so you're pretty sure that the big boys, the hedge funds, are not going to renege
right
on that. But even if they did, again, these are very popular loans that individual investors are knocking on the door saying, please,
right,
we have money. Because there's some people who don't want to invest in funds because they want control.
Right.
I get that. Yeah. I mean, when you invest in a mutual fund, you're trusting the manager is going to buy various stocks that will go up in value.
Exactly.
But that doesn't happen all the time. And so there's some people who say, I don't want to invest in a mutual fund because I want to control my portfolio. I want to invest in Facebook or IBM or General Electric, and then sell it at any time. So, so there's definitely people like that. And this is kind of the same thing. You're trusting the manager is going to do enough due diligence. The property is not going to disappear like a stock might, with a company going bankrupt. As long as the properties are decent properties, even if they go down in value, they're not going to go to zero. You have fire insurance and stuff like that.
And are they mostly California properties or exclusively?
Primarily California. They're in the main fund. There are a couple of properties that are outside, but that's only because the borrower has a California presence.
Okay.
Yeah. But other than that, primarily California.
Mm-hmm.
They also have another fund that is strictly construction loans, and that one pays a higher rate of return. But, a lot of people understand that, with construction, you have a little bit of different risks than you would for an existing house.
Yeah.
That one's paying 8%, So they have kind of a variety. One of the other funds that's kind of interesting is one where I'm actually one of the managers called the Southwest Note Fund. Mm-hmm. And you're from Texas, right?
I'm from Texas.
Yeah. And that's what we're doing. We're buying discounted seller carryback notes in Texas, paying 7.5% fixed. No fee to get in, no fee to get out. Just give 30 days notice. There's no hold on that. You can almost treat it like a money market. Now I got to give you the downside. Downside is it's been so popular that if anybody wanted to invest today, their money wouldn't even get used for about 2 months.
Oh, wow.
We're telling them if you can if you want to invest in a fund and be sort of, quote, first in line, but know that you're not going to earn anything for about 2 months, feel free to invest. And we've actually had a couple of people say, you know what, I'm earning 0% in the bank anyway. I just want to get in before anyone else.
Yeah.
Okay, fine. But just understand, you're not going to earn anything for at least 2 months.
Right.
It takes a while for us to find those loans.
2 months goes by pretty fast at our age though, right, Edward?
That is true. And I think I'm a lot older than you too. So it goes even faster for some.
Just a few years, not a lot.
Yeah. Anyway, for more information, you go to pacificprivatemoney.com. Check out the investor page and you'll see the 4 different funds, and you can always request information. And we don't have a trivia question, but when we come back, we'll have some closing thoughts on the best of investing. So stay with us.
All right.
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Mary Jo LaFaye, who's a reverse mortgage specialist. Now, Mary Jo, we have a couple more minutes before we have to cut out for our thoughts of the day. So tell us, what happens in divorce situations?
Oh, that's a great question. Yeah, I actually been getting a lot of calls recently. I think the close quarters and stress of COVID, people are filing for divorce, and the largest cohort of Americans, or the only segment of our population that has a growing divorce rate these days, is people over 50. And surprisingly, 1 out of 10 people getting divorced today is over 65. So the majority of people over 65 are either retired or getting really close to retirement, maybe working part-time, kind of scaling back, and trying to figure out how their money that they've saved over their working years is going to last them a 30 or 40-year retirement. Yeah. And so to be splitting the money in half at that age can be pretty detrimental to the cash flow that they're going to experience during their retirement years. Yeah. And what typically happens is one person will take the home and the other will take the retirement assets, or they sell the home and they each walk away with a little bit of money. But what we've been helping people do is the person that wants to keep the home can use a reverse mortgage to access the cash to buy out the departing spouse.
Okay.
And that way, nobody has to take on a mortgage payment, and nobody has to invade their investment portfolio to buy the other person out. So their income is intact. Their, being a homeowner without a mortgage payment is going to remain the same. And then the departing spouse takes the money they got from the spouse that's keeping the home, and they can use that for a down payment on their new home, plus use a reverse mortgage to purchase that new home, which means they put about half down, the reverse mortgage funds the rest. So now you've got two people that are homeowners, nobody's paying rent and nobody's paying a mortgage payment, and nobody took money out of their retirement savings. So it's pretty dramatic shift from what happened historically to older people getting divorced.
Yeah. And then if let's say the wife keeps the home, pays the husband with the reverse mortgage, when she passes on, then the husband's no longer involved in that house.
Then her, whoever her heirs are, if they had children, and she leaves it to her children or the cat or whoever she wants to leave that money to, the remaining equity.
And they have how much time before they have to deal with the reverse mortgage?
They automatically get 3 months, and they can refinance if they want to keep the house or just sell it and pay off the loan. Usually there's more than one kid that want more than one heir, so they want to sell it and split the inheritance. But if let's say there's one, or they work it out that one ends up buying the house from the estate, then they just pay off what's owed, pay off the other heirs, and they get to live there. And if they're old enough, a lot of times the parents are 90 or 100 when they're dying, so the kids are in their 60s. So then they can use a reverse mortgage to pay off their parents' reverse mortgage.
Wow, that's a good point.
I've seen that happen. And so it's, you can take one house, and if the heirs are all in their 60s, they can all split the proceeds and use HECM for purchase and all become homeowners.
That's that's very very smart. I like that.
Christmas miracle.
Yeah. Let's go ahead, if you would, give out your information one more time for people who have questions on reverse mortgages.
So the best way to reach me is just through my website. There's a lot of educational information and videos on there. And again, that's MaryJoLaFaye.com. If you forget that, just type in Mary Jo Reverse Mortgage Marin, and you will find lots of information about me.
Very good. Well, thanks again, Mary Jo. Always a wealth of knowledge on reverse mortgages. We're going to cut out today. Here's our thoughts for the day.
Thanks for having me, Edward.
Absolutely. What do you call a wreath made of $100 bills?
Thank you.
Aretha Franklin's.
Aretha Franklin.
Like that? And apparently I snore so loudly it scares everyone in the car I'm driving. All right. Tune in next week. No, that's not true. I don't snore. And I don't sleep in the car while I'm driving.
Yeah, I hope not.
Just so you know. Okay, I don't want to get a bunch of emails and phone calls. Oh my God, this guy out. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.